The stock market is highly correlated to the futures market temporarily. We're going to show you why this is happening and how we might be able to take advantage of it. Here, the area chart shows the Fed funds futures. That shows us the probability the Federal Reserve will not cut interest rates and keep them unchanged at current 425 to 450 levels. Then we see the blue line, that's the S&P 500. This goes back to October of last year. Now, what we can see over time, and we're going to show you with some more detail, is that when one market goes up, the other tends to follow. But this is not only the case, always the case. We're going to show you why this is happening now. Why does this correlation exist? We have to consider the economic narrative. Well, we have positive economic news. Lately, most of the reports have been pretty good. We have the risk of inflation. There's a fear that might be right around the corner. Stocks were, up until pretty recently, pretty strong, with a possibility the Federal Reserve would lower interest rates. However, more recently, stocks have been stumbling, with the perception the Federal Reserve may pause and not cut rates. Well, here's some example of the good economic news. Non-farm payroll. This was released a couple weeks ago, reporting 256,000 jobs. That was the best number since March of this past year. Now, speaking of inflation, the producer price index on a year-over-year basis, that was released at 3.3%. That was the best since February of 23. But that's not all. Consumer prices are also higher, rising to a level of 2.9%. That is the highest in about 7 months or so. So there is a risk of inflation, and the economic numbers are good, which leads us to believe the Federal Reserve will not and should not cut interest rates. And that in turn is leading to a stumbling stock market. Here we can see the area chart again. That's a probability the Federal Reserve will not cut rates. Now notice that this was moving up between early October and about the second or third week in December. And then it began to plateau. Keep this pattern in mind, because the S&P 500 during the same period of time was also rallying, but then began to stumble around the second, third week of December through present day. You see, what was happening is that as the Federal Reserve, or the perception the Federal Reserve would not cut rates, as that increased, the stock market started to wake up and says, well, maybe we're not going to get the interest rate cut that we are hoping for. And the stock market really kind of took a turn for the worse when these Fed funds futures moved above the 60, 70% probability, so to speak. And at the moment, we're in the high 90s. So the vast majority, pretty much all of us, do not believe the Federal Reserve is going to cut rates in January. And if you look further on down, the calendar, there's a good probability the Federal Reserve may not cut rates until May, and that's making stocks quite nervous. And we can see during this period of time that the stock market was quite strong. We were still, for the most part, under the perception that the Federal Reserve, they could cut rates, or if not in January, sometime down the road. But conversely, when the economic numbers started to get so good and the inflation numbers started to, really kind of approach the threshold of concern, that's when stocks really started to stumble. Now, how do we use this information moving forward? It's very nice that we tell us what's already happening. What value is there in knowing this? Let's remember our economic narrative. Remember, positive news coupled with the risk of inflation. Keep that in mind. The economic calendar. This next week, we have some numbers, nothing huge. The week after that, it is huge. Durable goods, new home sales, S&P Case-Shiller Home Price Index, consumer confidence. That's all just Monday and Tuesday. Wednesday, advanced retail sales, a Federal Reserve interest rate decision, press conference to follow. We have gross domestic product and pending home sales on Thursday. And Friday, we have that very, very important inflation number, the personal consumption expenditure. Now, with the release of every one of these numbers, we'll make a mental note. Does this fit with the current narrative, the narrative of good economic numbers and a risk of inflation? If, for example, we see, the housing numbers or the GDP or even durable goods that reflects a weakening economy, well, that in turn could lead, the Fed funds futures to price in a higher probability that the Fed's going to cut rates sooner than May. And that should, if history's any judge, bode well for stocks. And the same holds true in terms of inflation on Friday, the personal consumption expenditure. If that comes in light or cool, less than expected, well, maybe that takes away a little bit of a concern about inflation and gives the Federal Reserve more room to cut rates, especially if the growth numbers are not good. But conversely, if the inflation number comes in hot and GDP is strong, well, that leads us even further away from the idea of an interest rate cut. And again, if history is any judge, the stock market may not like that very much at all. Speaking of which, we've gone into some more detail about this very subject in our most recent Substack newsletter, Surging Stocks Addicted to the Fed. And it will provide you a link in the description of this video for exactly that article, as well as many other ideas that we've published in recent times. We hope this has been helpful. We look forward to seeing you back soon.